Welcome to Tradier's The Trader's Edge. I'm Jim Uriel. That's Bob Itino. Wait, didn't we count down and then there was like a musical interlude and then we came on live, or did we change that?
There was a brief musical interlude there. It was very brief,
It's
but it
very brief.
existed. There
Yeah, I
was
wasn't quite
we
ready.
got rid of the countdown because you and I are always starting late.
That could be the case. Yeah. Okay. Up 50 today in the equities. What the hell? Explain it to me.
Yeah, I honestly think it's the changing view of yields again. And I do want to, we got a guest coming on that's going to say this at some point, but we are really way too focused on the Fed. And the thing I've been saying lately, and then our guest confirmed it in one of his Daily Edge updates, at least confirmed that he thought the same as me, is that it's a be careful what you wish for thing with this rate cut. Right? Because we're starting to get some data that I don't want to say that it's showing the economy is weakening. It's something I'm going to ask our guest about. But some of this data is starting to track in the wrong direction, in my view. Yeah. And so, but it is, we're back to the CME Fed Watch Tool pricing in 2 rate cuts for 2024. It's June, man. We're running out of time for that to happen.
Yeah. Plus, it's going to look political as shit when they do it.
Right.
Yeah, I really think they're backed up against the wall. Again, they're backed up against the wall because they put themselves in that position. Yep. June of 2021, they missed the boat by about 7 months of when they should have started hiking rates. So, yeah, is their job hard? Yeah. Did they screw it up? They absolutely screwed it up. I am so excited to have Mike Singleton on because I think we are going to disagree about something. And like I said to you yesterday privately, I don't like when I disagree with Mike Singleton, and I don't like when I disagree with Jim Bianco. But you got to stand your own ground. So I'm curious what his thoughts are. And again, said a million times, you can think Bobby and I are full of shit, but you can't deny that we get great guests. Here's another great guest, Mike Singleton of Invictus Research. That's the music I was talking about. I was just off on the intros.
You were off on when it happens.
When it happens. Yeah, Mike, how are you?
Doing great. I'm honored that the musical interlude was right before I came on the show.
You came on, really exactly. It's like you're getting played onto the stage. It's like the Carson show. Oh, you don't know what
I also think you should be honored that Jimmy included you in a Jim Bianco comparison, right?
Yeah, I think so. Yeah.
He's illustrious for sure.
Yeah. Jim Bianco stands his ground, and he won't and he's right usually. And I'm just amazed. He starts from zero every time. And that's why I'm always really impressed with the way he does things. And you, I think, are following his footsteps. The only reason I say following his footsteps is because you're, 30 years younger than us, right? That's the only reason, right? How old are you?
28.
20. Yeah, exactly. 30, like more than 30. But anyway,
Jimmy,
go, Bobby.
Real quick, we got a question that I wanted to get put up, and I just start the show with a question because I think it's to all three of us, which is kind of good. So let's see if Mike wants to tackle this one first. Guys, do you think Canada's rate cut is a sign that U.S. will revert to ZERP and QE on steroids again? That's a very aggressive question.
Aggressive.
Go ahead, Mike.
I think the answer is no. Yeah, I think that question is probably too aggressive. It's like I ate a Chipotle burrito. Am I gonna have a heart attack tomorrow? The economic situation in the U.S. is very different from Canada. I think the Canadian unemployment rate is up like almost 100 basis points year over year. The U.S. we're still sub 4%. We can get into all the details about the U.S. later, but I think that the U.S. economic situation does not warrant rate cuts. You've got inflation accelerating by pretty much every measure, whether it's CPI or PCE or headline or core. Not really an environment in which it makes sense to be cutting rates, I don't think. We might still get one by the end of the year, but I have a hard time seeing a lot more than that.
Okay, so here's where I think we're going to disagree. So if you would have caught me a week or so ago, I think I agreed. Since that time, we've seen 1.3% GDP. The most important thing to me was the Atlanta Fed GDP Now model tracking for 4.2, and then all of a sudden, like hitting the brakes, saying no, 1.8. To me, like the rapidity of that move, I think, is a little frightening. And those ISM numbers on Monday, which were kind of crap. Is there anything of the last couple days that, I know everything makes you question, but anything that's making you seriously question?
Yeah, I think that is GDP the best measure of real-time economic growth? I don't really think so. And there are a few reasons that I don't think that. I mean, the first is that, GDP lags. First of all, as an investor, GDP lags stocks by like 6 months. And second of all, GDP is kind of an accounting contrivance in terms of how it's calculated. And there are a lot of accounting distortions as part of its composition, right? So if you look at like change in private inventories, it's a huge swing factor that dramatically affects the quarter-to-quarter print that doesn't really have all that much significance economically. Or if you look at net exports, or even government spending tends to be kind of acyclical. So they confuse the information value of GDP. One economic indicator that I tend to prefer for measuring real growth is the weekly economic index, which is constructed, I think it's by the New York Federal Reserve. And it's a composite of 10 different high frequency indicators like jobless claims, retail sales, steel production, electricity output, not accounting contrivances, hard data, stuff that's really hard to fake. And right now, at least per the most recent data that I can remember, the weekly economic index is indicating 2.2% real economic growth year over year. That's an acceleration, it's an acceleration versus the last several months at least. It's the highest level since I think January of this year. And, it looks very different than real GDP. So if I had the choice, I care about GDP, I think, as does everyone. But if I had the choice between trying to determine whether GDP is a more reliable indicator of what's actually happening or the weekly economic index, I'd probably go with the latter.
Yeah, so I think just to answer Dax Razor Live's question, from my point of view, I don't think they're related, to be honest. Canada's the first of the G7s to cut. We got a 99% probability of the ECB being second, but they're talking about, I should say a lot of analysts are talking about it being a hawkish cut. In other words, one and done for a while. And we've got Canadian CPI, whether that's the best indicator of their consumer prices or not. It's the only one I look at because I don't look at Canada much. And their inflation was down to 2.4% for 2 consecutive readings. It popped to 2.6, and then it looks like it's trending lower again. So I think it's a completely different scenario. The Bank of Canada indicated more rates to come. And I think with the ECB tomorrow, if it is a hawkish cut, in other words, they cut and say, we're going to hold here for a while, we're not looking to aggressively cut again. However, Christine Lagarde wants to word it, it'll further distance us from the idea that Canada has opened the floodgates for the Fed to do ZERP.
No, and I like that answer a lot too. And I think, again, I'm more negative the economy, I think, than Mike and Bobby. And I still don't think, I think that talking about ZERP and talking about an absolute panic is reasonable, but only by about this much. And I don't believe it's going to happen too. So Mike, the last we saw read on inflation was the PCE number, which came up kind of in line, nothing special at all. But then all of a sudden, it seems like there's much, much less worry about inflation. I think that's one of the reasons that rates have gone down across the curve. Is that true? Do you think there's less worry right now about stag or inflation?
I think so. I think when you look at government measures of inflation, that doesn't make a ton of sense, right? Because pretty much every government measure of inflation is accelerating, whether you're looking at a 3-month, 6-month, year-over-year basis. And, that has obviously implications for monetary policy in the markets. I think the most disinflationary thing that we've seen recently is copper and oil going down, and they tend to lead the measured inflation data. So that's a change, right? I don't have a super nuanced view into copper. It seems to me when I look at what's going on with oil, a lot of the selling, a lot of the decline that we've seen in the price of oil is a result of speculators, right? It's hedge funds deleveraging, and you can see it in the commitment of traders data. And commodities as a market where you have basically 2 types of investors, right? You have commercial actors and you have regular investors. And commodities have commercial use cases as opposed to stocks, which are just sort of investment assets or bonds. And so I suspect this is an instance where speculators are driving the price down, but the fundamentals are, in my view, still supportive of higher oil prices. It doesn't mean $100 oil, in the next 3 months, but I think the bias is probably higher from here.
Bobby, do you agree with that for oil?
Oil's a tough one for me because we just had the first indication of the possibility of more barrels out of OPEC. Now, obviously, they extended the production cuts. Okay, they extended all the cuts through October of 2024, which means in November, they're going to be considering the elimination of the voluntary production cuts, which is about 2.2 million barrels, right? And if the economy starts slowing, which is something I want to touch on with Mike in a minute, I don't think they'll do that. And that might snap us back higher, because while they open the door for more production, which they haven't done for almost 2 years, right? You've had Iraq overproducing anyway. So hence some of the pressure. You know, it's a completely different story from what OPEC says their level is going to be and what actually gets produced and put out in the market. And the market's very good at discerning that. All right. So I think that the path of least resistance for crude is probably higher. But you need an event. You need something to happen. Crude is doing that thing where it's trending again. And crude trends until it hits that area where the market believes supply and demand are relatively balanced. The last supply and demand range in crude oil we had was like $8 wide. So, you know, you can't even really call it balanced. So overall, but I wanted to touch on something. And I want to tell Max that I emailed him one of Mike's charts that I'd like to put up prior to the one I'd already prepared, Max, if you have it. But it's the idea that I know Mike has, because I read his research every day, that inflation is troughed too high. So can you talk about that? I mean, we're sort of heading higher from too high of a level, right? I mean, is that sort of your stance? And again, I'm surprising the guys behind the curtain here by telling him I sent you a chart, hurry up and get it up. So try and drag this answer on so I can possibly get the chart up.
Just keep talking until it comes up. I know. Yeah.
Right. Well, I think it's a pretty simple idea in the sense that we know most economic data, especially growth and inflation data, tends to follow sort of a sinusoidal pattern. You know, like the waves of the ocean.
Time out. You got to define that word. Sinusoidal.
It means that it oscillates up and down the way the waves of the ocean oscillate.
Okay.
Right. So, you know, if you want 2% inflation over the course of the business cycle, you kind of want the center of those oscillations to be around 2%. Maybe you want it to oscillate between 1.8 and 2.2. That would be, you know, the Fed achieving its target through a full cycle, right? So what we've seen this cycle is obviously inflation peaked at something like, you know, if we look at CPI, 9% in June of 2022, and then it's been declining since. So it was an important question where it would bottom, because you have to wonder when it does bottom, is that a level consistent with 2% inflation over the course of a business cycle? And it appears that we have seen at least an intermediate term bottom around 3.3% for CPI and 2% for PCE. And since that bottom, which was kind of in late December, a little bit earlier for CPI, we've seen inflation reaccelerate. And on a 6-month annualized basis, we're basically looking at around 3% inflation for the PCE measures and 3.5% to 4% for the CPI measures. And I think that I should have sent you the PDF. It would look a little bit cleaner. But
yeah, I took a screenshot of that. So
no, I like it though. It looks very good.
We can read it really well.
Yeah. Well, the point is hopefully clear, right? It looks like the trough for inflation this cycle is just, it's not at the Fed's target. And if it's troughing above the Fed's target, then the odds that sort of the median over the course of the next 5 years is probably not going to be 2%, unless we see a recession, which is possible, but just not imminently, I think.
Now, do you think this lines up with Jerome Powell's famous statement that I was never able to figure out about 3 years ago, that they need a adjusted average of 2%? You remember that? He said we need to get to an adjusted average. And since we've been below 2% for so long, we can be above it for a while. Does this fit that, or is this still just too much?
No, I think when I think adjusted average, I think you're like sort of widening the bands around that 2% over time. So I would think that means maybe like 1.7 to 2.3 over time. But I think a trough level of 2 or 3, you know, depending on which measure you're looking at, is too high by any measure. It's difficult to understand exactly what the Fed is thinking, because I think pretty much no matter how you cut the data, inflation is well above target and it's moving in the wrong direction. And the rhetoric from Chair Powell is pretty dovish, right? there's a quote that I've referenced a few times since the March meeting where he repeats the phrase, we'll get to 2% inflation over time, but he says it over time like 4 times in the course of 30 seconds. And then
trying to convince himself.
Right. And then he proactively reiterates it to the listeners, over time. And my takeaway from that is that he's not dead set on getting inflation to 2% anytime soon. He's dead set theoretically on getting it to 2% over some ambiguous period of time going forward, which could be a few years, right? If you look at the summary of economic projections, the Fed is not forecasting 2% inflation until 2026. And they're incentivized to probably massage those forecasts a little bit low, which is interesting, right? Because it sounds like over the short term, the Fed has kind of given up on its 2% inflation mandate. It's saying, it's using phrases like over time during press conferences and penciling in high numbers, several years going forward. I don't know how else to interpret that.
Can you guys, if you guys are able to, I won't say walk and chew gum because it's a little bit more complicated than that, but if you're able to walk and juggle at the same time, go over to X and repost what I just put up because we are live. And while Jimmy's doing that, because I want to give him the next question, Mike, what is, where can people find you and how the chart I just showed was created by you with information from the BLS. So I want to give you an opportunity early in the show to let people know where they can find you and how they can get that information.
Sure. So our website is invictus-research.com. And you can also sort of read some basic ideas on Twitter too at Invictus Macro.
Okay, it's a 2-part question. Okay, so you talked about inflation troughing, whatever, however you pronounce that word. So when you think about that, are you thinking about excessive government spending, keeping inflation in tow? I mean, keeping inflation elevated, about adjustments made to Social Security equaling about $200 billion each additional year in additional payments, and union contracts being negotiated all higher. So there's an element of the wage driving it. That's part of your thesis, correct? Which one's the most important in that? And then I have a follow-up.
The most important driver of inflation right now?
That's going to keep it elevated.
So inflation is the framework, if you take a step back, that I have for thinking about inflation is basically a supply and demand framework, right? Like inflation purports to measure the rate of change in the price level of goods and services. And we know from Economics 101 that price is always the intersection of supply and demand. So you could think about that, to use slightly different words. It's the intersection between growth in consumption and growth in output, right? So if consumption is growing more quickly than the economy can produce the goods and services being consumed, you're going to see faster inflation. So right now you're seeing roughly 5.5% consumption growth, and the economy can't produce 5.5% real GDP, obviously. So the difference between, call it 5.5% consumption growth and 2% GDP, that's inflation. That 3.5% delta is inflation. That's kind of where we're at right now. So, what are the proximate drivers of this 5.5% consumption growth? On a proximate level, we know that it's growth in payrolls and it's growth in wages and salaries. So we're seeing payrolls growth of about 1.5%. We're seeing about 4.5% or 4 to 4.5% wage growth. That gets you to roughly 5.5 or 6% consumption growth. Now you could ask a deeper question, what's driving above trend wage growth, in the 4 to 4.5% range as opposed to 2 or 3%, the decade before COVID. And that's probably government spending, right? I mean, if you look at how deficit spending tends to correlate with various economic statistics, it tends to correlate really closely with the employment statistics. And so more government spending tends to mean a tighter labor market, not a productive labor market necessarily. Usually it's not, but certainly a tighter labor market. And a tighter labor market usually means faster nominal wage growth. And that sounds really good, and all else equal, maybe it is really good, except that if it's an unproductive allocation of resources by the government, if it's an unproductive labor market at full employment, you tend to see low or negative real wage growth, even if nominal wage growth is high.
So there's a second part of the question, but just to add what Mike said too, if you've been looking under the hood at the BLS data for the last year to year and a half, there is an exorbitant amount of government jobs, healthcare jobs, education jobs, jobs that are either government or quasi-government. So to Mike's point, we have seen that through the government spending. It's not as productive an economy as we'd like. Some of the jobs are trash. Now, Larry McDonald's new book, When Markets Talk, People Listen. By the way, when I paraphrase it and said that like that, you don't either disagree too much, right? I mean,
No, that's good.
a lot of, okay, good. So Larry McDonald's book, How to Listen When Markets Talk, I think is fabulous. His contention is that the last 30 years were characterized by a disinflationary period. Those are all the gnashing of the teeth and beating of the breast by the Federal Reserve, talking about how they needed inflation and need to spur it. And then, be careful what you wish for. His contention now is that the growth stocks, the NASDAQ that's done great over the last 30 years, are now going to take a back seat to commodities, things that do well in an inflation, in a 3% inflationary period, because we all agree that it could be that way for the next 5 years. I personally have a little carve out for some of the AI names that might still continue to do well. What about that thesis do you like or dislike?
So I think that, you could just sort of, if you take a very long-term perspective on things, it appears that we could be on the beginning of sort of a big run for value and commodity-related stocks. Because if you just look at the relative performance of growth versus value and commodities relative to other assets, value and commodities have underperformed for a pretty long time. And since COVID, they've actually done well relative to other assets if you measured off of the COVID bottom. But I think you could make the case like, look, just historically, these cycles last, 10 years or 20 years or whatever. We appear to have troughed. Maybe we're in line for a 10 to 20 year run where we really see where we have strong inflation that results in value outperformance, higher interest rates, strong performance from commodities. The case, I don't have a super strong view on it because I think it depends on a lot of inputs that are hard to predict. A lot of it will depend on policy, right? Like I could imagine a scenario where commodities perform extremely poorly. Like if we get a president like the president of Argentina right now, and there's a ton of deregulation with regard to natural resources, I have no doubt that commodity prices will go down, right? And there will be economic. I wouldn't just rely on a chart that says these cycles last 10 years and say, okay, well, this has to be happening for the next 10 years, because just sort of in an academic way, right? A lot of that is policy dependent, and I don't have any edge in forecasting policy, but I'm reasonably adept at understanding the implications of different policies. So I'd rather wait and see what actually happens and then react to it rather than proactive. I'm sure Larry McDonald's not necessarily making 10-year investments right now. I'm sure he would adapt to the incoming data as well.
Of course, yeah.
But that's more so how I think about it.
Bobby?
You're saying Larry sucks. Is that what you're saying?
Larry, did you hear that? You have to come on.
I actually just had a friend who does not work in finance who mentioned the book to me and said, you have to read this. So I think I do have to read it. I'm hearing it from enough quadrants in my life that I think I need to do it.
I just ordered it, so I'll let you know. Jimmy's been pushing it for a while.
Yeah.
So here's a question I have, and I have one of your charts for this as well. I want you to explain why and it's a two-part question, why with a 70 to 75% services economy does manufacturing PMI, in your opinion, correlate so well with stock performance? And then I've got a follow-up to that I'll just ask it now. Did it bother you? So obviously the ISM manufacturing prices component fell, but it was still 57, right? And for people who don't know, 50 represents sort of the dividing line between expansion and contraction. Above 50 means an expanding data set, and below 50 means a contracting data set. And while the prices were still very high, they were lower, but the new orders was brutal. It was 45.4, expected at 49.4, last to 49.1. So first of all, why do you think they correlate so well, so highly? And did the new orders component bother you?
The short answer on the last part is yes. I like most analysts, I consider different factors, many different factors when considering a forward outlook for growth. That's one negative input. I think that there are enough positive ones to remain bullish. But, when you see new orders decline precipitously for manufactured goods, that's not great. Although, look, the manufacturing PMI data, I really like it. Obviously, I quote it a lot. It is a diffusion index. It is essentially a measure of sentiment, which means it can be a little fluffy sometimes. We just got the Census Bureau data on new manufacturing orders, and it was pretty good, right? If you looked at the core capital goods orders, the non-defense and non-defense and aircraft new orders for capital goods. It increased at over 2% on a month-over-month annualized basis, 3-month annualized basis, a 6-month annualized basis, and the year-over-year number was like flat. So essentially what you're seeing is the shorter term measures of momentum in manufacturing are going up, and the year-over-year data is going to catch up over time, assuming we don't have some sort of shock. So all in all, I think the manufacturing data is pretty good. Certainly when you look at the performance of industrial stocks and the relative performance of industrial stocks, especially equal weighted, it's hard not to conclude that, whatever is happening, financial markets seem to be bullish on manufacturing growth. You also have $2 trillion in federal deficits, much of which will be devoted toward, different type of spending that will benefit the manufacturing industry in the U.S.
Yeah, manufacturing-ish stuff, right?
Ish. Manufacturing broadly, I guess. I think there's enough to be bullish, but the new orders is a problem. There's no doubt about it. In terms of why the ISM manufacturing PMI correlates so closely with stocks or with earnings, I think it's because if you look at the volatility of the services industry, it's pretty muted, right? It's relatively steady. It does cycle, but not nearly as exaggerated as the goods economy tends to. And so it's just a function of, even though it's small, the moves are so large that they cause the entire business cycle to oscillate. It's like when gas prices, when you look at CPI and how it's composed, like gas prices are only a couple percent weight, but they change so much that they can influence the headline number a great deal, because it's the weighting times the amount that things change. And manufacturing tends to change a lot relative to services.
I wondered if your answer was going to be similar to Mike Arnold's, where Mike Arnold, we ask him why a particular pattern works. He says, I don't care. It does.
There's an element of truth to that.
I mean, you look at that chart on the left-hand side of that chart, and the correlation to the stock market moves is just, it almost makes you do something stupid like just trade it, which I'm not recommending, by the way.
We don't recommend any trades.
I do think the point of the chart is really, look, what is the ISM manufacturing PMI? It's a measure of the growth cycle, right? And you can get more specific, but in spirit, that's what it is. And so the point is, if you can anticipate where growth is going to go, that's helpful in anticipating where stocks are going to go.
Mm. Okay, so Bobby and I don't ever talk about politics. We know shit about politics. We do know a little bit. Don't smile at me, Mike Singleton. We talk about policy, because that was like an eye roll. I get that from my wife. We talk about policy. Now, when you look at the upcoming election, there's two candidates. I'm not sure there's as much of a distinction between the two from a fiscal standpoint as many think. I do think there is some. What are the different risks compared to different candidates winning?
So I think that the good news for investors is most of these risks are upside risks. I think that no one's talked about this in a while, but there's currently $700 billion in the Treasury General account that will be spent at Secretary Yellen's discretion. Mm-hmm. It hasn't come down.
I talk about it all the time, by the way. But anyway, go on.
It hasn't come down quite as quickly. Every minute that she waits to deploy that money is, another day, another week, another month closer to the election. So whether that's intentional or not, it's a political upside risk for stocks that she starts to deploy all of that money as we get closer to the election. I think you're right. Both President Trump and President Biden are big spenders. I think that the fiscal deficit will remain high no matter who's president. I do think it's worth acknowledging that if a fiscal deficit is high because of tax cuts, basically what that does is it allows the private sector to allocate more resources, which tends to be more productive over time. And if you're running a deficit because of more government spending or higher taxes, you're taking money away from the private sector and allowing the government to allocate more capital, which tends to be less productive. Not to say there's not space for that or that that's an actionable trade implication. It's just, that's the nature of capitalism, is that central planners, central banks, federal governments tend not to allocate resources as well as businesses, in particular small businesses. The U.S. has historically had a very good economy, in part because it had a very robust private sector and a very strong small business backbone.
So I've got Bobby. Do you notice Mike says the same things as we say? He just says them so much more eloquently and diplomatic and without swearing. I like that about you, Mike.
I am 100% stealing Fluffy, by the way.
Well, I liked Fluffy when he said Fluffy.
Stealing Fluffy. I'm like, the stocks. I'm gonna see this stock's a little fluffy. As a matter of fact, I'm doing Bloomberg this Friday. Bloomberg Canada. I got an interview and they want stock names. that I like, and I'm going to use Fluffy. And I'm
Good.
actually going to ask Mike the stock names in a little bit so that I can steal those too.
Steal those as well. Okay. There was another word you used too that meant oscillation. Give it to me one more time.
Sinusoidal.
Sinusoidal. See, I've never even heard that. Like Michael Farr used diminution this morning when I was on a podcast with him, and that one at least I could figure out what it meant. But sinus infection or whatever.
I was all proud. I used dissolution today, and I was all proud.
I'm proud of that. Yeah. Okay.
one.
So we were talking about policy, not politics, and the different candidates. The first time President Trump won in 2016, he hired Carl Icahn, and Carl Icahn's job was it Carl Icahn who was supposed to be the czar of sensible deregulation. It didn't last very long. Carl Icahn left. But is that if Donald Trump points his attention in that direction, is that automatically going to help small business optimism, automatically going to help medium-sized business optimism? Is he a more pro-business president?
I would say yes. I think generally speaking, I think the framework that a Democrat would use is that he's pro-business and less so pro-consumer. I think that's sort of a false dichotomy. There's little doubt he's more pro-business though. And I think that even on Wall Street, most people acknowledge that the NFIB data tends to be more affected by the party of who's in office, right? So small business sentiment was higher under President Trump than it was under Biden, even if you adjust for the economic changes. And I think that's a reflection of certainly their self-perception, right? Small business owners tend to perceive economic conditions to be better than President Trump. The question that you need to ask is, are they deceiving themselves, or do they not know what they're talking about? Or
does it matter? Does it matter? Right. If they're optimistic, they still may be walking out the risk curve, expanding anyway, right?
And it's a self-fulfilling prophecy, so to speak, like you said.
Okay, that's interesting, Bobby.
Yeah, I wonder so recently we had the JOLTS figures, and correct me if I'm wrong, but I don't remember in your research you talking about those much, and I hate them. It was one of those things. I mentioned this in a show before that every once in a while you have to become an expert on a new thing all of a sudden. Somebody mentions that it matters. A few years back, it was hurricanes. We had to become experts on hurricanes because the Gulf was getting hit by a couple in a row. And then it became rig counts. Yeah, I've been trading crude oil for 25 years. And all of a sudden they're like, look at the Baker Hughes rig counts. I'm like, the what? I actually thought it was a new piece of data, and I realized they've been putting them out for 77 years. Baker Hughes has been putting out the U.S. rig counts. I feel like JOLTS is that thing now. JOLTS dropped. That's the JOLTS jobs opening to, I think it was 8.05 million, and the quits rate was up a little bit. Do you care about this particular piece of data? Were you surprised when the Fed said they look at it? And if you don't care about it, why don't you? Because I don't.
So I would say that the guiding principle I have with economic data is if I can connect it to something tradable with a straight line, I'm generally interested in it. Sort of like Mike Ronald said, why do I care more about the ISM PMI data and specifically the manufacturing PMI instead of the FRB industrial production data? Because isn't that what
it's out better, right?
It's because it correlates better with stocks. Like in principle, I should care more about the hard data because it's using accounting data, right? It's using, cars produced and stuff like that. And the PMI,
GAAP or non-GAAP, which is it?
Right, exactly. But it's theoretically more reliable than just a survey response from a purchasing manager. But in practice, stocks tend to like the purchasing manager data more. So as a result, I do, even if the data integrity isn't quite as good. So as a result, I tend not to care as much about the JOLTS data on its own because it doesn't correspond or lead any of the important data that closely. I look at it because I've got some free time, I guess, but I don't look at it because I think it's going to help me become like a great trader or anything. But I'll caveat that by saying Chair Powell does care about it and monetary policy does matter. So I'll pay attention to it to the extent that he cares about it, because I think that if you're trying to trade pretty much anything and you're ignoring one of the Fed's inputs, then you're kind of handicapping yourself a little bit.
You know what that reminded me of, Jimmy? Do you ever see Tommy Boy?
Yeah.
If you want to get a look at a butcher's ass, I got time. I got nothing but time.
Side note, my wife went to college with Chris Farley, Never liked Chris Farley at all. said that the women, she said the guys loved him. You know, he was always fun, but the women were always kind of scared of him. Like he was the kind of guy who'd break through a window and do panty raids on a girl when she was asleep and stuff like that, just for the stories he could tell. And my wife did not. We had to turn that shit off. I had to watch Tommy Boy in secret. But anyway, can I ask a question of you two both? It's not really market related. It's about data collection. Because I posted a thing today and I got in an argument with two liberals on site, like two guys I know. And I posted that, I think it's that Polymarket Interactive surveying. And they posted it, 4 different data sets. And it was Trump versus Biden head to head. Back when the trial began, month after the trial began, 2 months, and then today. And the whole time it kept graduating higher for Trump, more Trump, to the end with, it says Trump 56, Biden 37. And both these guys were like, well, that's bullshit. You know, there's no, and I said, no, I'm not trying to ascertain from this chart, because their methodology might be all whack. I'm not trying to ascertain if it's really 56 to 37 or whatever I said. What I'm saying is, if their methodology stays consistent at all 5 measures, then what we can tease out of it is that the balance of Trump to Biden is moving in that direction. You know, it may be Biden's still ahead, but based on their methodology. You know what I mean by that, or no, Michael?
Vaguely.
Let's forget that whole question. Because I'm not saying that is Trump really leading by 20 percentage points. I'm saying if if it's the same 2,000 people that they're surveying, and they slant one way, well, what I'm measuring is the change of the slant. Let's forget this whole thing. When this show goes live, let's cut this part out. It was a dumb question. Oh, it's live already? Great. Okay, good. Bobby, your question.
I don't know. I mean, to me, it's like, I think one of the problems that people have now, and we could talk about this with markets. Okay, I'll refer to markets, but it applies to policy and politics as well, is that when you see evidence that you're wrong, if you're not willing to accept that evidence and go, well, okay, so clearly, and by the way, I never like telling people that their trade is wrong, because if you're using a process to choose a trade and the inputs to that process changes, the only time you're wrong is if you don't accept the change. And that's something that I'm stroking you a little bit, Mike, from Invictus here. But that's something I noticed when I first started following your research about 2 years ago, is that there's times where you go, so things have changed. So here's what we're looking at now. And I just think, you know, if you're going to be in a cult, fine, be in a political cult. Do not be in a market cult. Do not, you know, because it's literally, you're just going to be broke. And there's nobody enjoys being broke.
And we've seen it a million times, people. Yeah.
How hard was that for you to do? I sort of know your story on this, Mike. I sort of know your story on how you came to accept data much more clearly. But can you go through that again?
So I think that there are a few elements. I guess the first, in terms of like what changed in terms of economic circumstances, that December meeting from the Fed was pretty clear. I think that was a very conspicuous pivot from hawkish rhetoric to dovish rhetoric. And to me at the time, and I was biased too bearish. I mean, it just sounded like Chair Powell was saying buy stocks. And, you know, that ended up being a pretty good time to buy stocks as it happened. It was a very good 3 or 4 month run in stocks until the local peak that we saw in April, although we're at all-time highs again now. So,
yeah,
you know, in any case, I thought that was such a distinct pivot. And it was at a time when you're already starting to see the private sector start to reaccelerate. And as soon as you see like interest rates collapse really quickly into an organic acceleration, you know, that's generally a pretty good time to buy. And then on the other side of that, you know, just in terms of trading yourself, when you feel your portfolio starting to lose too much money, especially on the short side, you know, you have that feedback mechanism that, you know, like, hey, something's changing, like things aren't acting the way that I thought they should. And that's also an input into the process, right? Like if you have some portion of your book selling short and you're just getting clobbered for a few days, you know, it forces you to reevaluate, unless you just have so much money you don't need to worry about it. But I don't know anyone like that.
So I wanted to ask you, part of what I was leading up to here is we're at new all-time highs today, at least in the NASDAQ. I'm not sure if we were in at anything else, but I know the NASDAQ not only hit a new all-time high, but hit a new all-time high close. But I noticed, and I mentioned it when Jimmy and I did the rundown. It's on 3 consecutive days of declining volume, at least in the futures. I know you do support and resistance in terms of like kind of judging if something still looks good or not. Do you take something like volume into consideration at all in terms of your recommended trades?
Yeah. In terms of the weekly trade ideas, yes. In terms of overall, like evaluating the indexes in the direction of the market, less so. More time spent on fundamentals. But yeah, I'd like to see what I'd call bullish volume profile before buying something or recommending it or suggesting it in the weekly trade ideas product.
So what? Yeah. So what do you? To whatever level you're comfortable, what is your most recent weekly trade ideas telling you? You can be general, you can be specific, whatever you want. People pay for this information, so to give it for free, I understand if you don't want to or can't.
So I guess I would say, well, first let me start with what I look for in a long idea, because I think that's sort of a useful way of framing it.
Sure.
Generally, I don't know if are you guys familiar with William O'Neill?
Yeah.
Sure.
Yeah. So I'm a disciple of William O'Neill among other investors. So I like strong trend, momentum, cross-sectional momentum or relative strength. I like buying all those things. I like buying breakouts. I like buying good risk-adjusted returns. So things that are breaking out right above support and have reasonable air pockets before they hit resistance again. With respect to volume, I like to see a breakout in strong volume. I like to see more up volume than down volume over the preceding couple of months. That's generally a good indication that a stock might be getting interesting. I will say, step back from sort of a market strategy perspective. Despite a very good day in the stock market today, we're clearly seeing declining breadth across pretty much every major index right now. So if you look at the percent of stocks in the Russell 2000 or S&P or the Qs above their 20-day, 50-day, 200-day moving average, they're all making lower highs. All of those breadth lines are making lower highs. And so what that suggests is the risk of a pullback here is elevated. Now, these breadth divergences don't have to resolve lower necessarily. And when economic conditions are good, the odds of them resolving lower are lower. But I think it's worth acknowledging that this market is probably not, I've said before, it's not ready for prime time, right? The breadth isn't good enough to say that this is like a great bull market yet. It's a good bull market, and it's been better in 2024. But I think that you need to see more participation in small caps. You need to see more participation from the average stock within the S&P 500. And we just haven't seen that yet. And the fact that these breadth lines are declining, even as the headline indexes are making new highs, I think one way of framing it might be like, I'm 80% net long now, but I'm looking to go to 100 if I get the right signs. So good bull market, not great, not yet. I think it'll get there, but not seeing the signs.
Okay, so this is my question to you is that one thing we've established, and one thing I really like what you. And by the way, people who are watching this, Invictus Research, it's a paid for service, but it is absolutely worth it. It's one of the newsletters, my first thing in my inbox every morning. I read it. You said before that we're in a little bit of a disagreement about the trajectory of the U.S. economy. What can you name 5 different indicators, or if you look at less than that, that you'll start to look at, and if they start to fall one by one, what will make you change your mind?
So I have to say, as much as I pay attention to economic indicators, I think generally the first indication you're going to get that something is awry with financial markets is going to be from the market internals. So as Stan Druckenmiller says, the best economist that I know is the inside of the stock market. And what he means by that is the performance and really the relative performance of the different stock sectors and style risks. So I'll give you 3 that I look at, and I'm watching closely now. Credit spreads, or you could look at the ratio of high yield bonds to like duration treasuries, high beta to low beta stocks, and consumer discretionary to consumer staple stocks, or more broadly, just cyclical equity sectors to defensive equity sectors. Right now, all of those signals are pretty much fine. They're still trending higher. They're still in a bullish zone. If I saw them start to break, that would be really bad. Regardless of what I think about is going to happen with the economy, that would be sort of a risk-off signal, right? And those were the types of things that you were seeing going into COVID, which was kind of a black swan, right? Your economic outlook could have been anything, and you would have been wrong. You would have been wrong buying stocks into COVID, but the market internals tend to get ahead of that. And so that's one of the most important risk management techniques that I use is I'm just constantly monitoring the market internals. Are the things that are supposed to be going up given what economic conditions are? And if they're not, why not? And if there's not a good reason for it, then, you want to preemptively take risk off before the market takes risk off for you.
So just a quick little follow-up, Bobby, then I'll take it to you.
Yep.
So yesterday you saw the metals complex get smacked. There didn't seem to be much of a reason for it to me other than it had been perhaps too elevated. I'm talking more about gold and silver. Copper makes more sense to me. More about gold and silver, and they got hammered pretty good. I thought it was market position because I didn't see anything else that made sense, particularly rates are going down. How did you interpret that move?
I probably don't have anything more intelligent to say than that. It's just, I think that when I have to look at a chart of gold to make sure that I'm not speaking out of turn.
Today came back and
it came back
ahead
today.
of yesterday.
So when I look at gold, I see sort of a sloppy, high volatility consolidation pattern between, call it 2250 and 2450 an ounce. And look, like most consolidation patterns, I think it'll resolve in the direction of the underlying trend. I think gold will probably go higher, but generally you want to see volatility start to decline. You want to see the width of that consolidation start to narrow a bit before you get more bullish or start, buying more gold, so to speak. So the way that I would say it is, I think gold probably goes higher, but the fact that this consolidation is so volatile makes me think it needs more time to digest.
It makes sense. Bobby?
Yeah, if gold can close above 2387.50, it's likely to make new highs, and I put that probability above 50%. Not going to go much more aggressive than that. So you're still in your reflation camp, is that correct? So that means expanding economy and higher inflation, for lack of a more complex definition. And in your equity sector back test, you've shown time and time again in your research that there's some sectors that outperform. Energy, I know, is one of them. Industrials is the other. Go ahead and throw them in when you answer this question, because I don't remember the 3 or 4 of them that are at the top. I think technology might be in the top 5. But is there ever a time, because you just talked about how, a good way to say where your position is, you're 80% long, but you'd like to get to 100. Number one, is it also correct to say you're 80% invested, but if things change, you'd probably go to 60 or 40? Is there a complex time for that shift? Number one. And number two, do you ever take trades that are not in the sort of sectors that outperform when the conditions are such that the stock itself looks good based on your criterion? Or is that something where like, this stock looks good, but relative to the sector it's in, I probably should avoid this one? Does that ever happen?
I would say that there's a higher bar for getting long sector and factor exposures that don't backtest particularly well. But if there's a really good setup, I might still buy something, because sometimes a stock is misclassified for whatever reason. So a good example of that right now is I like BRCC. And it's classified as a consumer staple stock. I don't know if you can see the chart. I like the chart. Coffee company.
Oh,
and
okay.
It's classified as a consumer staple stock. And maybe it's a consumer staple stock. It depends on how you think about coffee, I guess. But is Starbucks a consumer staple stock? Like the way that it trades? Are most coffee companies consumer staple stocks? Another one is Bros. It's another coffee company, I think, that I like. I like the setup as well, and had a good day today too. Even though these are technically consumer staples, and I'm biased bearish against consumer staples, they don't trade like staples. And the setups are really appealing to me for a variety of reasons. So with names like that, I'm not thinking as much about the back test. I'm thinking, look, this is generally a risk on market regime. These are some great setups. I'm just going to buy them. I'm not going to think like, well, what was GICS thinking when it classified them as a consumer staple?
Yeah. So tell me this, with the coffee company. So, because sometimes I get so confused. And before, the coffee companies always kind of correlated with the price of coffee, which doesn't make a ton of sense considering coffee is probably an input cost to them, correct? But if you really kind of tilt and squint, you can say, well, maybe they can, get a higher margin if prices are going higher. But mostly it's nonsense that they correlate with the price of coffee. Is that correct in your opinion?
to be honest, I did not know that they correlated so closely with the price of coffee.
They used to. I don't know if they did. I haven't traded some of the bigger coffee names in a while. They used to. Bobby, you know or not?
Yeah, they used to.
But maybe people got wise.
It detached when we lost pricing power, or I should say coffee companies lost pricing power during that period of flat to no inflation that we had over a decade or so. The correlation broke down. And like we talked about with the correlation of gold and the Swiss franc, they break down, right? And that's one of the things, like I look at 30-day, 90-day, 120-day correlation every 30, 90, or 120 days or so to see if anything has shifted. And when I looked at coffee versus coffee companies, it broke down when there was no pricing power. The pricing power is there now. I just traveled from Florida to Chicago and back, and I bought an espresso at Starbucks, and I think it was $482 for a double shot. It was insane how much it cost. And by the way, that coffee is the rape of my culture anyway, so I don't even know why I was buying that. But they have pricing power again, at least temporarily. So that may be why they're lining up again.
So it was funny. I was traveling. I traveled to Austin last weekend, as you know, and I was coming back, and I'm in the airport, and I need something to eat, and I look, and there's these dark chocolate covered. Is it pecans or pecans? My wife and I had an argument about this when I was ranting. How do you say the nut?
It's pecans.
Pecans, is it pecans? Okay, so let's say pecans. It's kind of fancy like you guys. So I look at dark chocolate covered pecans.
He didn't agree with me. He didn't agree with me.
He didn't agree. I go up to the counter. It was $26 for a bag like this size. I said to the lady, and I said, no. I don't want those for $26. And I brought it back. And I can afford them for $26, but I'm not going to spend. It was just what my point is.
That's like 2.5 Big Macs, kid.
Jesus Christ. I'm like, at what point in time do people say no? I'm not doing that. We're seeing that now, right? I mean, higher prices are oftentimes the cure for higher prices. Correct, Mike?
I used to eat a lot of pecan. I say pecans.
Thank you, Mike.
because I say pecan pie. Yeah, it doesn't sound right to say pecan pie.
No, it doesn't at all.
But anyway, I used to really like pecans, and so but they were always expensive. I remember always thinking, like, my God, like half my grocery budget is just pecans.
You know, pecan is what we used to call the can in my clubhouse that I built when I was 11.
And you had to be in
because we wanted a bathroom in there, so we got an old coffee can. We called it the pecan.
Fantastic.
That was killing my appetite.
What else is new in your life, Mike? You going on any vacations this summer or no?
I'm going to North Carolina for a week in August.
Oh, that's nice.
And other than that, I don't think so.
Your age is a big North Carolina group. Like your age group there's a lot of North Carolina there.
Where do you go? Asheville?
No, it's a beach called Holden Beach. It's just north of the Outer Banks. No, excuse me. It's just north of Myrtle Beach. It's south of the Outer Banks.
Well, that's cool. That's awesome.
You gotta have the real stuff. You got to go down to the Florida where the real ocean is, or never mind.
Well, Bobby, in the summer, like, when you go on vacation, now that you live in a popular vacation destination, do you go on less vacations? Would you take a day off and just go out on the ocean where you are, right?
So this is completely a waste of Mike's time, but I'll explain it. I have said to people, one of the things I like about living down here is I take 1 to 2 hour vacations almost every day. Like if I have a break, I literally will run over to the pool or sit by the pool. And there's a big palm tree there and stuff. And it's like,
that's fantastic.
All of a sudden I'm gone and then I come back.
Yeah, that's awesome.
So these mini vacations, someday it'll get old.
If I can get you ice baths, because now I'm about to take an ice bath, and that's like my mini tranquil vacation as well. Quick funny story: I needed an extra. We had 2 freezers, but they're all filled with shit. So I ordered this chest freezer on Amazon, and about a day after I order it, my wife is at Costco, and she goes, "They got a big freezer here. It's like, it fits in the truck, and it's probably like $400." I said, "Okay, buy it. We'll return the one from Amazon." So we get the one from Amazon now. And she goes to return it, and they said, "No, you can't return it, and just keep it anyway, and we'll give you your money back." So now we have 4 freezers. I'm the only guy I think right now with 4 freezers. So I'm doing pretty good, I'd say. Wouldn't you guys?
That's true on my end, by the way. And I'm Italian, so I know people with 2 or 3 easily.
That's my definition of success right there.
Thank you, Mike. That's what I was fishing for. Okay, he is Mike Singleton. And the reason I don't feel as bad about wasting his time is because we are tirelessly trying to sell his product because we believe he's one of the best. The least he can do is give me 5 minutes to rant about some stupid shit. But that's what I think. I'm just kidding, Mike. Thank you as always for coming on. You can find him on Twitter at Invictus, at Invictus, or is it at Invictus Research?
It's at Invictus Macro.
Okay, at Invictus Macro. And if you're not reading his stuff now, you should be, because it really does arm you for the day, for the week, for the month of trading. This is Trader's Edge. This is Trader's Edge. I'm Jim Uriel. That's Bob Icino. Thank you guys so much. There's nothing without the support you guys give us. We appreciate it a ton. Remember what Bobby and I's mission is. We were in mainstream media for a long time. Turns out you can't say exactly what you feel on mainstream media, so you kind of got to create your own platform, which thanks to Tradier, we've been doing that here, and thank you guys.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.